Michael, you focus, and you have for more than a decade, on the collateralized loan obligation market. People have raised concerns about it recently, and I'm wondering, do you think that there is legitimate trouble brewing in this market?
This is a market, as you say, that has been around for 25 years. And so I think what we're seeing today is the normal push and pull of supply and demand going after one another. We are indeed getting into a point where we have some economic weakness. We're not anywhere near a recession in our minds.
Wait, hold on a second.
Yes.
Economic weakness. What are you pointing to in particular?
We're seeing some companies that are not performing as well as they had been a year ago.
But is that economic, or is that related to specific companies that might have gotten financed just fine a little while ago?
I would say it's a little bit of both. It's industry by industry. Certain industries don't lend themselves well to operating in a highly leveraged environment. People with volatile commodity inputs or a lot of labor exposure or exposure to tariffs. And with leverage, it's more difficult. But the CLO market has been through crises in 1998, 2001, 2, and of course 2008, and has come through with really good performance for all investors involved.
One concern that people have is that there are constraints for how much of the lowest rated debt CLOs can buy. And there's concern that if there are downgrades, there could be forced selling. Do you see that as a possibility?
No, that's not exactly right. It's not a forced selling scenario. What there is there's a finite amount of shelf space for any CCC rated companies. And of course, that moves up to the B3 rated companies that might be the next CCCs. So what you see is an increase in the ante to get into a portfolio as a B3 company, so that new issues that might be coming that are rated B3, now they have to pay a much higher rate in order to qualify for that limited space in CLO portfolios.
So you don't see that as sort of a looming pressure?
It's a constraint, and that's a constraint that can break one of a few ways. Either B3s will get cheaper so that it's worth owning more of them, or we'll see more new issuance come at a B1 or B2 rating to alleviate some of that pressure that the CLOs have.
We've seen a number of loans decline in price quite significantly, and this has come in tandem with ongoing outflows from retail funds. And I'm just wondering how you interpret that.
So the whole appeal of the CLO market is that it's not the retail funds. These are institutional vehicles that are not redemptive. They are never forced sellers. That is why they have succeeded in periods of volatility. In fact, a lot of times CLOs are the beneficiary of price volatility in the market, as they can be a non-mark-to-market buyer of any loan that they deem creditworthy.
So have you seen institutions continue to invest heavily in CLOs?
Absolutely. CLO issuance has been very, very strong this year, well over $100 billion for this year as well as last year. And while I think in 2020 we're expecting a little bit of a reduction, it's still probably going to be a $100 billion year.
And we have seen the Bank of Japan recently issue some guidance, a warning to Japanese investors about the potential for price drops. Does that affect anything?
That's right. I know that there's a focus on, hey, what about the price drops? But if you read the report, as many of us have, they reiterate that these AAA notes that most of these Japanese banks own have very, very little credit risk and have never experienced any losses.
And they haven't pulled back?
They have not pulled back, though they were very heavy buyers, some of them, in the beginning of this year. And I think they filled a lot of their quota when spreads were wider. And I think if spreads widened in the fourth quarter, we could easily see them come back in.